Hey guys, Rudy coming at you live from Palm Beach in Florida. I don't even know what day it is. I know it's April the 3rd, and I know it's the day after what President Trump called Liberation Day. And I think for the most part, most of us were liberated out of a few $1,000s or tens or hundreds of thousands of dollars out of our stock trading accounts. So I'm back to one Maserati, two Maserati, three Maserati, like in days gone by, right? But that's not what I'm going to do in this video. And I'm not going to bore you with news you already know or you already heard of. What I wanted to do is talk to you about some stocks, five energy super majors that you could pretty much just buy right now. And if I say these are recommendations, today's an easy day to make a recommendation because all stocks are down, which makes it particularly difficult to pick a winner or two. I think if you're in the energy sector, it's relatively easy because at the end of the day, if you just hold it long enough, you'll be okay pretty much anyway, as long as you're buying a good quality issuer and preferably one that pays dividends as well. But these are the five I'm going to talk to you about today, and I'm going to tell you why you could potentially buy these, or otherwise, if you want, just add them to your watch list and maybe, usually I say watch when there's a pullback and then you can buy them. But today is probably that pullback, right? So let's talk about these five and see why it is that you could possibly add these to your portfolio. So the first one, Exxon. I mean, Exxon's actually sort of a no-brainer. Exxon and Chevron, for that matter, are sort of no-brainers. Why? Exxon is the biggest non-state owned oil company by market cap. It's got a market cap of around 50 billion. Well, that was when I made the slide. Today it's probably around 475. Powerhouse in upstream and downstream with 21.4 billion barrels of oil equivalent in reserves. 59.9 billion acquisition of Pioneer Natural Resources. That was a win in 2024. It boosted its Permian Basin outlook and output and locked in some low-cost production, which is a sweet deal for Exxon because effectively they reduced their marginal break-even cost on a per barrel basis in the Permian. Cash flow strong, 55 billion in operating cash flows in 2023, and it is committed to shareholder returns with a 3.2% dividend yield and share buybacks, right? The other thing is it's less exposed to the renewable hype, which is not really something that I'm interested in, as you would probably know by now, and it sticks to oil and gas where the profits are still king. Let's take a quick look at the slide here. This is all these slides were taken today. So this is April the 3rd after the carnage in the marketplace today. So when I took this slide a few minutes ago at around 3:30, you could buy Exxon for about $113. I actually did buy some Exxon today. I added to my existing position, and over 1 year it's down 5%. Now you can sort of if you want, you can view it as a bit of a wash because it pays a dividend of almost 4%, right? And if you're down 5%, you're pretty much treading water, which arguably is not great. But in the stock market as it is today, that's not bad at all because most stocks are down and some of them are down quite significantly. The 1 year target date, $129. The PE ratio is decent. Um, so all in all, not a bad stock, this one. You could probably just buy it and hold it. And in theory, you can sort of almost just hold it forever. What about its cousin, Chevron? So Chevron's market cap around 287. Obviously, right now it's probably at around $250 billion. It's got a balanced portfolio, 11.1 billion barrels in reserve, a heavy presence in the Permian. Its $53 billion Hess acquisition is still pending and adds Guyana's massive offshore fields. That's an interesting bit of news if you're interested in Chevron and maybe Exxon for that matter. There's an interesting little battle going on here because Hess was a minority shareholder in the Guyana massive offshore oil field, which is primarily owned by Exxon, right? So Exxon and Chevron probably don't want to coexist side by side, but by acquiring Hess, Chevron is actually sort of uh, dipping its toes and treading into Exxon's asset. So interesting little fight playing out here. The dividend yield's around 4.2%. It's higher than Exxon's and it's raised dividend payouts for 37 straight years, right? So another one that you can sort of buy, hold, and forget, right? Just put it in your portfolio. Don't worry about it. It'll be fine, especially longer term, right? Low PE. suggesting it's undervalued, especially for its cash flow potential. So looking at this little chart here, kind of interesting too, right? So what you have here is a decent earnings per share. You got a PE ratio that's kind of low. You got a nice dividend of almost 4 in terms of where it's trading at right now. A 1-year target of $176. It's only down 2.3% after today's carnage. So today it's down about 6% or so. But once again, over 1 year, you're down 2%. You got a 4% dividend. If you reinvested the dividend, then in theory, you'd be up 2%. So not bad at all. You can buy a Chevron at around 156. Now, talking about these two, and of course, I've talked about this many times before, you could also just buy XLE, which is the ETF, and they're approximately 20% each. About the XLE has about 20 something percent Exxon and about 16, 17% Chevron. So both of these are good buys. You could just hold them and keep them. Why? So Shell is a global giant with a market cap of around 225 billion. It has 9.6 billion barrels of oil in reserve. It's producing about 1.5 million barrels of oil daily. It's leaning into natural gas, which is not a bad thing, but oil is still core. Its dividend yield is decent, and it's on track to beat Exxon in cash flow for 2025 if the oil prices hold. Well, we don't know if they're going to hold, and obviously today is not really a good day to kind of make that guesstimate. It's diversified, and it's got a growing LNG business as well that's hot right now. The only thing I don't like about Shell is the fact that they dabble a little bit too much in renewables, although they've pulled back significantly and are now focused mainly on oil and gas again, which is preferred. Looking at their chart, so interestingly enough, even after the pullback of almost 4% today, Shell over the last 1 year is still positive. Add the dividend to that, and you're up 4% or thereabouts. Decent earnings per share, nice PE ratio as well. It's a cheap one to buy right now if you want to diversify across different geographies as well. So instead of holding just Exxon and Chevron, which is obviously predominantly US domiciled, Shell gives you a little bit of a more of a global feel in terms of where they trade and where their assets are. And then there's another global one here, Total Energies. This one's like really super cheap right now. It's French, so if you have the stomach to actually keep anything French in your portfolio, assuming that you're comfortable with France as a jurisdiction right now, in the days gone by, I sometimes used to make comments about jurisdictions that I'm not comfortable investing in. Right now, you could probably say France, with its lawfare that they currently are exercising against people like Marine Le Pen, is probably not a jurisdiction that's favorable or viewed favorably by many, many people. But hey, if you want to invest in energies, Total Energy is not a bad deal at all. France's oil titan, $165 billion market cap. Obviously, it's also down a bit today. Pumps 2.5 million barrels daily and has about 11.5 billion barrels in reserve. It's got assets in Africa and the Middle East, so it's a nice geographical hedge as well. And it hedges with natural gas and some renewables. So the renewables to me are irrelevant. In fact, it's a losing money bet. So I'd rather they not do that. But anyway, they probably feel they have to, and jurisdictionally, they're almost compelled to because they're in France. The dividend yield is very, very juicy at 5%, and it's dirt cheap because of its forward PE at under 8 right now. It's got a high yield. Its valuation is super low. It's a great value play, especially if oil prices climb, which they should. Total Energies you can buy right now for about $62 on the NASDAQ exchange, sorry, the New York Stock Exchange. And currently it's down 13%, so it's probably near its lows. So depending on your risk tolerance, now might be a good time to get into it. Very attractively priced. The PE ratio is under 10. The earnings per share is decent. The forward dividend yield is like over 5%, and a 1-year estimate from the analysts of $72. So upside in terms of stock price, upside in terms of the macro, in terms of oil prices, upside as it relates to the dividend, if you can reinvest the dividend as well. Not a bad buy. The drawbacks, it's France, and there's still a large focus on renewables for Total Energies. How about this one? Back to the United States, ConocoPhillips. And this is really looking like a sweet deal right now. So I'm always hesitant to say you should just buy it, but you can certainly add it to your watches. ConocoPhillips is a sweet deal right now. It's smaller than the other four that I mentioned. It's got 132 billion market cap. In fact, today it's down quite a bit. So it's probably market cap down 110, 115. It's a pure play upstream beast with 6.1 billion barrels in reserve. The $22.5 billion Marathon oil buy in 2024 added 2 billion barrels, which boosted both its Permian and Eagle Ford output. It's got a 3.8 dividend yield. That's up 34% just in 2024, and it plans $7 billion in annual buybacks. The nice thing about ConocoPhillips is it is laser focused on oil production and not renewables. So just from that point of view, ConocoPhillips would probably be, of these five, my favorite, especially when it's super, super cheap. The difference between them is that I can sort of buy and hold Exxon and Chevron and forget it. ConocoPhillips is more a stock that I would perhaps add to my portfolio and trade maybe over a 2, 3 year period. Take the profit. In other words, ConocoPhillips for me is more like an Occidental or a Petrobras or something like that. Not a set it and forget it kind of stock. Looking at its chart here, it's super cheap right now. You can buy ConocoPhillips for under $100 just today. It is down more than 9%. At one stage, it was down 10% year to date. Not year to date, sorry, over 1 year, it's down 26%. Sometimes stocks test their lows, and I'd go out on a limb here and say maybe $100 or thereabouts is Conoco's. It's probably the basement price. I think from here on, this is the floor. It's probably hit its low. I mean, if it pulls back a little bit more, like $95 or so, that would probably be then like literally the floor. I can't see it dropping much further from here. The EPS is decent. The PE ratio is also nicely priced. It's way under 15, which is comfortable. It's got a nice dividend, $3, and a 1 year target price of $128, right? So if you buy it for $100 and it does go to $130, that's 30% upside, assuming the analysts get it right. And of course, on a day like today, it's on sale, as are the others, but this one particularly is on sale. You know which other one's on sale today? Phillips 66. I added some Phillips 66 to my portfolio today. It was down when I bought it, it was down about 12, 13%. Stocks don't go on sale too often, and that's why you keep some dry powder, so you keep some cash in your account. So when there's a significant pullback on a stock with great fundamentals, and especially if it's one that pays a nice dividend, and has been doing so consistently for many years, is not a bad time to take a little bit of that cash and put it to work and add to an existing position, or otherwise potentially look at opening a new position. Just do your due diligence and homework before you just jump in, boots and all, right? And if you're skeptical or scared, and if you're not sure, buy a little bit, don't just take all your cash and just buy one thing. Why these five stocks? So oil prices are volatile, right? So we know that the WTI, when I printed the slide, it was $70. Now it's down to like 65, $66, right? But demand is still growing, especially in Asia. Well, it's not just Asia, right? It's also growing day over day, day after day, day after day. We use more and more and more and more. Um, and the oil demand over time as international communities and populations are just uplifted slowly, sort of edging the way for many, many people who don't even have clean drinking water or very polluted air. Oil is one of those products that lifts people out of poverty. And even if it feels incremental and it's slow, little by little, every single day, um, just a few years back, we were still using 85 million barrels per day. Today, we're running at about 104 million barrels per day, and that demand will just keep increasing. The graph exponentially for consumption will just look like that. Over time, it just grows and grows and grows, the demand, right? Doesn't matter what the prices are, doesn't really matter. I mean, if you can buy them cheap and get into the stocks at a decent price, it's a bonus. But if you just hold it for a long time, you're going to be pretty much okay if you invest in energy. These super majors, the five that I talked about, have the scale, the reserves, and the cash to thrive if prices rebound. As for instance, let's say OPEC plus cuts or tightens supply. Exxon and Chevron dominate in the United States. Shell and Total Energies offer some global exposure, and ConocoPhillips is a lean oil machine, right? Should have highlighted that, lean oil machine. Financially, they're all solid. They all have strong free cash flow, manageable debt, and dividends that beat inflation. Some risks that you can watch for. The oil price can dip below $60. So as we see today, I mean, it's very volatile. And just today it dropped down, WTI dropped down to about 65 or so. But if it dips below $60, it will need to be there for a long time for there to be significant downward pressure on these five stocks and long term. So, I was trying to think of some examples. People always say, China, the economy is slowing down. China's economy is actually growing quite nicely. In fact, one of the other economies that is growing quite nicely, whether we like it or not, is Russia. It's one of the fastest growing economies in the world right now on a price producer index basis. EVs could surge. I'm not sure about EVs though. I mean, some people like battery operated cars and they're fun to drive and it's kind of new and it's funky and all that kind of stuff. But I don't know about that one. It's got to be something else. I don't know. Maybe you can let me know in the comments what you think. Shell and Total Energies dabble in renewables. I don't like that risk at all. So of the five, they're my least two favorites. And of these least two favorites, I like Shell a lot more than Total Energies for a couple of reasons, including the ones I mentioned. And renewables might dilute their focus if green energy flops, which arguably it already has. And of course, the Hess delays, and these are court delays as well because they're fighting each other over this deal, which includes the Guyana field that could stall Chevron's growth. So anyway, that's the story on these five. You can let me know what you think in the comments. I mean, this is not a difficult pick, especially on a day like today when everything crashes and tanks. It's rather easier, right? So there's a big red subscribe button here that somebody must have put there. But anyway, if you like my content, hit the subscribe button. Those are the five, right? So if you're interested in any of them, you could probably buy them on a day like today. If you already own them, you could maybe add a little bit, and otherwise add them to your watch list and see where they go and follow them for a while, and then decide. But in the greater scheme of things, they're all relatively easy. The first two, Exxon and Chevron, kind of set it and forget it. You can keep it in your portfolio. You don't have to trade it. You don't have to do anything with it. You can just keep it. If you can reinvest the dividends, that's a bonus. In fact, that'd be highly recommended. So enroll your stocks into a DRIP, a DRIP, which is a dividend reinvestment program. That's the way that you can benefit best from compounding and make lots and lots of money. So I know it's been a scary day, and I'm trying to sort of lighten the mood a little bit. But that's my story for today. Thank you for watching. Remember to subscribe if you want to. And thanks for following along. And I'll talk to you soon. Take care. Bye-bye.